James, it's great to have you on Worldwide Exchange. I mean, listen, there's a billion things to look at and try to analyze and guesstimate right now. What are the one or two most important things to you when trying to understand these equity markets and global economies?
Yeah, Brian, we got a lot of uncertainty here. I think for me right now, the biggest thing that's going to happen fairly soon is that the economic data and the flow of fundamental information, I think it's going to start to bottom out and start to bounce. And the reason I think that's so important is that when data has been in complete free fall, because when you hit the off switch in the economy, it sort of becomes irrelevant. There's just little to be gained from whether the GDP is going to be minus 30% or minus 60%. It's all just horrible either way. But so what it does is disconnects everyone from any fundamental information flow, and everyone's just left to judge things really just by emotion. And that's kind of what we've been through so far, I think, is emotion is dictating a lot of what's going on in the financial markets. I think
it seems a little ridiculous on some of these economists trying to say, "Oh, we estimate 3.5 million job loss." Honestly, who cares? It's 3.5 million people. It's a lot of families. That are scared. It's just varying degrees, sort of badness. Is there any way to gauge what's really going on? We're trying to tell the story on CNBC by talking to restaurant owners, looking at traffic data, doing those things. What are you looking at to try to really understand where the collective American economy is? Because it's very different in many places. We're here in New Jersey and New York. This is kind of ground zero for what's going on. It's very different in other places.
Yeah, I think so. That's why I think it's important that we start to get data that bounces a little bit. And if we get confidence data that bounces, and even unemployment claims, they've already started to bounce. And they're still terrible, but they're starting to come down a little bit. I think that'll help us look at what's happening here. There'll be some parts that aren't recovering, perhaps. There'll be other parts that will start to show recovery as we start to reopen the economy. And that's going to do a lot. That reconnects investors with some fundamentals, calming, I think, some of the anxiety, reducing volatility of the financial markets. I think companies have to make a decision every day whether they're going to hang on to get to the other side of this or whether they need to start cutting costs and cutting more jobs. If they see data bounce, that's going to help build confidence for them to hang on. It's going to help bring information for policy officials. Do we need more support for the unemployed? Do we need more support for industrial activity? Do we need more support for retail? As opposed to just a blunt instrument of providing stimulus everywhere. So the reconnection, I think, here is going to start as economies come back online. I think that'll also help reduce anxieties and improve confidence to some degree.
Okay, let me ask you this, Jim, and I don't know if you know the answer to this, because the economy and the stock market are two very different things, as we know. Okay, stock market's supposed to predict. Market had a decent little rally, sort of retracement off its lows. Everybody's like, oh, it's the reopening rally. Who's owning stocks or buying stocks right now? The data shows $1 trillion has gone into cash in the last 30 days. $1 trillion. Everybody I talk to on Wall Street says the only people trading right now are Millennium and Citadel and the big quant funds, and everybody else is just kind of sitting it out. What are you seeing?
I agree with that, Brian. I think that there's not a lot of buyers. I think what's happened, which often happens, not uncommon at all, is the selling has stopped. And oftentimes when the market takes off, go back to March of 2009 when the market bottomed in the great financial crisis. I don't think that there was any buyers in March of 2009 after what we went through. But what happened was everyone that wanted to sell, everyone that wanted out was out. And once you had all the nervous sellers out of the way, once you had all the forced selling out of the way, then even a few marginal buyers against no sellers caused the market to rise. I think the same thing has happened here. And what I think the next stage is eventually is that if confidence does start to rebuild again, that we are maybe headed back up, then you're going to get buyers again. I think we're not there yet.